Right now, while headlines scream uncertainty and markets swing on emotion, something far more important is happening quietly behind the scenes. Massive capital is moving. Not retail money, not speculation, serious billionaire money. And here's the part most people miss. These moves aren't reactions, they're decisions, calculated, deliberate, and timed when confidence is scarce and conviction is rare. Three stocks, three powerful signals, and a message the market is leaving in plain sight for anyone willing to look past the noise. Because when the smartest capital in the world starts buying while everyone else is still debating, it's not a coincidence. It's preparation. Stay with me. What you're about to hear isn't hype. It's a blueprint. When capital moves at scale, it never does so casually. Every dollar deployed by serious investors carries intent, analysis, and an opinion about the future. Over the last few months, we've seen that intent made visible through public filings, billionaire investors increasing exposure to dominant, cash-generating businesses at moments when headlines were noisy and sentiment was divided. That contrast matters. Because while the market argues in real time, disciplined capital looks several years ahead. Take the renewed interest in mega-cap technology and media platforms. These are not speculative stories. These are businesses with global reach, entrenched ecosystems, and balance sheets built to survive economic cycles. When billionaires add to positions here, they are not chasing momentum. They are underwriting durability. They are betting that scale, data, and distribution still win in an environment where capital is no longer free and execution matters more than vision alone. Look closely at what these companies represent. They control attention, they monetize behavior, they convert innovation into recurring revenue at a level few competitors can challenge. That is why, even after years of growth, they remain relevant to sophisticated investors. The question isn't whether these firms will grow at breakneck speed forever. The question is whether they will continue to compound value while weaker players fall away. The capital flows suggest the answer is yes. What's often misunderstood by retail investors is timing. Billionaires don't wait for certainty. They move when probabilities tilt in their favor. Recent buying came amid regulatory pressure, macro uncertainty, and debates about valuations. And yet, that's precisely when opportunity tends to emerge. When fear compresses prices, but fundamentals remain intact, disciplined investors step in. Not loudly, not emotionally, quietly and decisively. Another critical point, these purchases weren't isolated trades. They were portfolio statements. Increasing exposure to market leaders signals confidence not just in individual companies, but in the broader trajectory of innovation, productivity, and digital infrastructure. It reflects a belief that the next phase of growth will be captured by firms already embedded in daily life, not by unproven narratives chasing attention. There is also a lesson here about patience. Billionaire investors are not optimizing for headlines or quarterly applause. They are optimizing for asymmetric outcomes over long horizons. They understand that owning exceptional businesses through volatility often produces better results than attempting to time every swing. That mindset separates speculation from strategy for everyday investors watching from the sidelines. The takeaway isn't to copy trades blindly. It's to study the framework, focus on quality, demand cash flow, respect scale, and recognize that when the most analytical capital in the world commits to establish leaders during uncertain moments, it's rarely accidental. Markets reward preparation, not prediction. And right now, the signal is clear. When conviction meets opportunity, capital doesn't hesitate. It concentrates. What separates enduring investors from reactive ones is not access to information, but the discipline to interpret it correctly. In recent months, billionaire buying activity has revealed something subtle yet powerful. Conviction is being expressed through concentration, not diversification for comfort. When capital of that magnitude increases exposure to specific businesses, it's a signal that risk is being measured, not avoided. These investors are not blind to volatility. They understand it better than most. They've lived through cycles where liquidity disappeared, correlations broke down, and narratives collapsed overnight. So when they deploy capital today, it reflects a clear assessment that the risk of not owning certain businesses outweighs the risk of short-term drawdowns. That's a critical distinction. The market obsesses over price movement. Serious capital obsesses over business momentum. The companies attracting billionaire interest share common characteristics. They dominate their lanes, they generate cash consistently, they possess pricing power, data advantages, and operating leverage that compound over time. These are not fragile growth stories dependent on cheap capital. These are machines designed to perform under pressure. And in an environment where rates are higher and scrutiny is relentless, that resilience becomes even more valuable. Another overlooked element is optionality. Billionaires don't just buy what a company is today, they buy what it can become without jeopardizing its core. Platforms with massive user bases, strong balance sheets, and embedded infrastructure can pivot, expand, and absorb disruption. That optionality has real value, especially when innovation cycles are accelerating. Capital flows toward flexibility, not rigidity. There's also a broader macro interpretation. Recent buying suggests confidence that the digital and data-driven economy remains the backbone of global growth. Despite geopolitical noise and policy uncertainty, these investors are aligning with businesses that benefit from long-term trends rather than short-term stimulus. That's not optimism, it's pragmatism. It's an acknowledgement that productivity, automation, and scale will continue to drive returns even as conditions tighten. Importantly, these moves are not attempts to call market bottoms, they are expressions of relative advantage. Billionaire investors know they don't need perfect timing if they own superior assets. Time, execution, and compounding do the heavy lifting. This is why they're comfortable stepping in when sentiment is mixed. They're not trying to win the next quarter, they're positioning for the next decade for observers. The lesson is not imitation but alignment. Ask better questions. Why does this business attract capital at this stage? What risks are being discounted? What advantages are being protected? This is how professionals think. They don't chase excitement, they pursue inevitability. Markets have a way of testing conviction before rewarding it. The recent actions of billionaire investors suggest they're prepared for that test. They've chosen businesses they believe can absorb shocks, adapt to change, and still deliver outcomes over time. That's not speculation. That's a strategy executed with scale and confidence. There is a persistent myth in markets that the biggest investors are always chasing the newest idea, the next disruption, the story no one else has seen yet. The reality is far more disciplined. In recent months, billionaire buying activity has leaned into businesses that are already proven, already dominant, and still misunderstood by the broader market. That choice speaks volumes about how seriously capital evaluates opportunity. At this level, investing is not about excitement. It is about durability. The companies attracting fresh billionaire capital are not defined by a single product cycle or a temporary surge in demand. They are defined by systems, platforms that integrate technology, distribution, and data into self-reinforcing advantages. When you own a system like that, time becomes an ally. Competitors struggle to catch up, regulators move slowly, and customers rarely leave without friction. What's important to understand is that these investors are not ignoring risk. They are reframing it. To them, the real risk is owning businesses without moats, without pricing power, and without the ability to fund their own growth. In a tighter capital environment, those weaknesses are exposed quickly. By contrast, the companies being accumulated by billionaires can invest through downturns, acquire distressed competitors, and emerge stronger on the other side. That asymmetry is intentional. There is also a strategic element. Key to scale that often gets overlooked. Scale is not just about size, it's about efficiency. Larger platforms spread fixed costs over massive revenue bases, turning marginal improvements into significant cash flow. That cash flow then fuels further investment, creating a cycle that is difficult to disrupt. When billionaires increase exposure to these businesses, they are effectively betting on that cycle continuing, not on any single quarterly result. Another layer is behavioral. Markets routinely misprice consistency. They reward surprise and punish predictability, even though predictability is often what produces the most reliable returns. Billionaire investors exploit this disconnect. They add exposure when steady performers are temporarily overshadowed by louder narratives. They understand that attention rotates, but fundamentals endure. There's also an implicit statement about governance and execution. Large, established firms with disciplined leadership and operational depth can navigate complexity in ways smaller or less mature companies cannot. For investors deploying billions, that matters. You are not just buying revenue, you are buying decision-making under pressure. Recent purchases reflect confidence that management teams can allocate capital wisely in an uncertain world. For those watching these moves, the insight isn't that markets are about to surge or collapse. It's that capital with the longest time horizon that is positioning itself where outcomes are controllable. This is not about predicting the future with precision. It's about narrowing the range of outcomes and stacking probabilities in your favor. In the end, billionaire buying is less a forecast and more a framework. It tells you where resilience is priced too cheaply and where long-term value is still compounding quietly. In markets, that quiet conviction is often the most powerful force of all. One of the clearest signals in markets is not what investors say, but where they commit capital when conditions are uncomfortable. In recent months, billionaire investors have done exactly that. They've stepped into positions while inflation debates, rate uncertainty, and geopolitical risk dominated headlines. That timing is not accidental. It reflects a belief that uncertainty, when properly priced, creates opportunity rather than danger. At this level of investing, macro noise is filtered, not feared. Billionaires understand that markets are constantly distracted by short-term narratives, while long-term value is built through execution and endurance. When they increase exposure during periods of hesitation, they are expressing confidence that the underlying businesses can operate through turbulence without impairing their competitive position. That confidence is grounded in data, not optimism. A critical factor behind these purchases is balance sheet strength. Companies attracting billionaire capital are not dependent on favorable financing conditions. They generate enough cash internally to fund innovation, manage costs, and return capital when appropriate. In an environment where weaker firms are forced to retrench, this financial independence becomes a strategic advantage. It allows leaders to play offense while others play defense. There is also an important lesson about perception versus reality. Markets often conflate slowing growth with failing businesses. Serious investors do not. They distinguish between normalization and deterioration. When revenue growth moderates after an expansionary period, headlines turn negative, but cash flow often remains robust. Billionaires use these moments to accumulate positions, understanding that sustainable profitability matters more than temporary acceleration. Another dimension is regulatory and public scrutiny. Large, influential companies are constantly examined, criticized, and debated. For many investors, that creates hesitation. For billionaires, it creates clarity. They assess whether regulation meaningfully impairs the business model or simply raises barriers to entry. More often than not, increased scrutiny entrenches incumbents rather than displacing them. Capital flows follow that logic. These investments also reflect a belief in organizational depth. Businesses that employ world-class talent, invest heavily in infrastructure, and maintain operational discipline can adapt faster than markets expect. That adaptability is hard to quantify, but it shows up in results over time. Billionaire investors are effectively underwriting management quality and institutional competence, not just products or services. For those observing from the outside, the takeaway is not that risk has disappeared. It hasn't. The takeaway is that risk is being selectively embraced where the payoff justifies it. This is a measured confidence, not bravado. It is built on stress testing assumptions and accepting volatility as the price of long-term returns. In markets, comfort is rarely profitable. The recent actions of billionaire investors reinforce that truth. They are positioning themselves where uncertainty meets strength, where fear creates discounts, and where disciplined businesses can turn complexity into advantage. That is how capital compounds when others hesitate. The final piece of the puzzle is understanding what buying $1 billion really represents at a philosophical level. It is not a prediction about tomorrow's market open or next month's earnings. It is a declaration of belief in how value is created over time. When capital of this magnitude is deployed, it reflects a worldview, one grounded in structure, incentives, and long-term compounding rather than short-term applause. These investors operate with a different clock. They are not measured by daily volatility or weekly sentiment shifts. Their focus is on whether a business can sustain relevance, defend its advantages, and adapt as conditions evolve. Recent purchases suggest a clear answer. The companies being accumulated are viewed as essential infrastructure in a modern economy, not optional participants. That distinction is critical. Essential businesses survive cycles, optional ones struggle. There is also a strong message about discipline. Billionaires do not confuse activity with progress. They are willing to sit in cash, wait through rallies, and endure criticism until probabilities align. When they do act, it is because multiple variables, valuation, competitive position, cash flow durability, and strategic optionality, have converged. That convergence is rare, and when it appears, hesitation is costly. Another key insight is the role of concentration. Diversification protects against ignorance, but concentration reflects understanding. Recent buying activity indicates that capital is being focused, not scattered. That focus implies deep research, high conviction, and a willingness to be wrong in the short term in exchange for being right over the long term. This is not reckless, it is calculated exposure to outcomes that are asymmetric in nature. There is also an implicit rejection of noise-driven investing. Markets are saturated with opinions, forecasts, and reactions. Billionaire investors filter all of that out. They study incentives, unit economics, and structural trends. They ask whether a company's advantages are strengthening or eroding. When the answer is strengthening, price volatility becomes secondary. Ownership becomes the priority. For OB servers, this creates an important reframing. Success in markets is not about constant action or perfect timing. It is about developing a framework that enables you to act decisively when opportunities present themselves. Billionaire buying is not a signal to chase. It is a signal to think more deeply about quality, endurance, and alignment with long-term trends. Ultimately, these investments reinforce a timeless principle. Capital flows toward competence. It rewards businesses that execute consistently, allocate resources intelligently, and compound value quietly. While headlines will continue to rotate and sentiment will swing, this form of investing remains remarkably stable. In the end, markets don't reward conviction alone. They reward conviction that is supported by structure, discipline, and patience. The recent actions of billionaire investors remind us that enduring success is built not by reacting to the world as it is, but by positioning for the world as it is becoming. So here's the real question you should be asking yourself as this video ends. Why now? Why in a market filled with doubt, hesitation, and endless opinions did the most disciplined capital on the planet choose this moment to act? Because history is clear on one thing. The biggest opportunities rarely announce themselves with comfort. They appear when conviction is tested and clarity is scarce. Long after the noise fades, long after the headlines change, these positions will still be sitting there, quietly compounding, patiently proving a point. The crowd will realize it later. The prepared recognize it early. And in markets, that single difference decides who watches history and who profits from it.